Welcome to the video on using a health savings account as a powerful, tax-efficient tool for long-term wealth and healthcare planning. In this episode, we will demystify the triple tax advantage, show you how the receipt strategy works, and help you decide when an HSA-linked high-deductible health plan may make sense. Let's begin. Here's today's roadmap. First, we will define the HSA and its triple tax advantage. Next, we'll explore the receipt strategy and how to implement a digital receipt system. Then, we'll compare HSAs to FSAs and IRA, or 401k accounts. After that, we'll discuss who might benefit most from an HDHP. We'll then visualize compounding over time, take a couple of quick quizzes, and finish with key takeaways and a call to action. Before we proceed, please note, this video is for educational purposes only and is not tax, legal, or investment advice. Regulations can change, so confirm details with a qualified professional, or the IRS HSA eligibility requires enrollment in a qualifying high-deductible health plan. Always keep documentation and substantiation for any reimbursements. With that in place, let's move forward. An HSA is a health savings account available to those enrolled in a qualifying high-deductible health plan. It's designed to help you pay for qualified medical expenses in a tax-advantaged way. Importantly, funds can roll over from year to year and can be invested, meaning the account can serve both near-term medical needs and long-term financial goals. Now, let's explore what makes it so potent. Here's the triple tax advantage in action. First, contributions reduce your taxable income or can be made pre-tax via payrolls. Second, the money can be invested and grows without current taxation. Third, when you withdraw for qualified medical expenses, those withdrawals are tax-free. Additionally, after age 65, non-medical withdrawals are penalty-free, although they are taxable like traditional retirement accounts. This unique combination makes the HSA extremely powerful. Many people wonder whether the real magic of the HSA only happens if you save decades of receipts. The optimal approach is to pay current medical expenses with non-HSA funds while leaving your HSA invested to compound over time. In retirement, you can reimburse yourself for those prior qualified expenses from your HSA, tax-free, using the documentation you saved. This gives you a flexible pool of tax-free funds that you can access strategically when it makes the most sense. To implement the strategy, you'll want a reliable digital system. First, choose both a cloud storage provider and a local backup location. Next, create a consistent folder structure by year and provider. Then, scan or photograph every receipt and name the files with the date, provider, and amount. Maintain a tracking spreadsheet or app noting date, provider, amount, and medical purpose. Save explanations of benefits and invoices, and cross-reference them with your receipts. Finally, reconcile your records regularly and keep redundant backups. This sequence shows the life cycle of a receipt. You pay the provider out of pocket, scan the receipt, upload it to your cloud storage using a consistent naming convention, and then log the details in your tracker. Keeping redundant backups and maintaining discipline around naming and storage makes future reimbursement straightforward and audit-ready. Meanwhile, your HSA stays invested and continues compounding. This flowchart helps decide between paying with cash and saving the receipt, or using the HSA card immediately. If you have a solid cash buffer and a long time horizon, paying cash now and preserving the HSA for investing can maximize compounding. Conversely, if cash flow is tight or a bill is significantly large and unexpected, using the HSA card provides immediate tax-advantaged relief. If your HSA has high fees or limited investment options, it may reduce the benefit of saving the HSA for growth. Regardless of the path, always document qualified expenses. Comparing HSAs and FSAs. HSAs offer the triple tax advantage, balances roll over indefinitely, and funds can be invested, but they require enrollment in a qualifying high-deductible health plan. HSAs are owned by the individual and remain portable. FSAs, by contrast, often have use-it-or-lose-it rules with limited carryover or grace periods, are typically not investable, and are tied to an employer. FSAs can still be valuable for predictable, near-term healthcare spending. Here we contrast the tax treatment. HSA contributions are pre-tax or tax-deductible, and growth is tax-free. Withdrawals for qualified medical expenses are tax-free. Before age 65, Non-medical withdrawals are taxable and penalized. After 65, non-medical withdrawals are taxable but penalty-free, similar to a traditional 401k. By comparison, traditional IRA and 401k contributions are pre-tax with tax-deferred growth and taxable withdrawals, while Roth accounts are post-tax with qualified tax-free withdrawals. In general, HDHPs paired with HSAs can be attractive for very low healthcare spenders who rarely use services, or for very high spenders who often hit the out-of-pocket maximum, especially when premiums are lower. Moderate and unpredictable spenders may prefer more comprehensive plans. Always run the numbers comparing premiums, employer HSA contributions, expected out-of-pocket costs, and the quality of the provider network. Also evaluate HSA investment choices and fees. The pie chart is illustrative only and not a prediction. This timeline emphasizes time as the central driver. Early on, you begin contributions and invest while saving receipts. In the middle years, your balance grows and you continue logging expenses. Later, the account benefits from compounding and potential catch-up contributions. In retirement, you can reimburse previously documented expenses to generate tax-free cash flow, balancing withdrawals with continued investment, depending on your needs and market conditions. Quiz time. Question: which of the following is not part of the HSA's triple tax advantage? The options are 1. Tax-deductible contributions, 2. Tax-free growth, 3. Tax-free withdrawals for any purpose at any age, and 4. Tax-free withdrawals for qualified medical expenses. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is tax-free withdrawals for any purpose at any age. That is not part of the triple tax advantage. Only qualified medical expenses are tax-free. Before age 65, non-medical withdrawals are taxable and penalized. After 65, they are taxable but penalty-free, similar to a traditional retirement account. Quiz 2. True or false? You must keep physical paper receipts for decades to reimburse yourself tax-free in retirement. The options are true and false. You may pause the video now to consider your answer. We will reveal the answer in the next section of the video. The correct answer is false. You do not need to keep physical paper receipts. Digital copies are acceptable, provided they are legible, securely stored, and part of a clear audit trail that documents the qualified medical expense. Here are some practical markdown notes you can use in your documentation or README. First, an example folder structure by year and provider with an illustrative file name. Second, suggested tracker columns to keep your log consistent and searchable. Third, a quick checklist to ensure each receipt is named correctly, logged, and backed up. Incorporating these standards will make your long-term record keeping much easier. These are the core points. The HSA offers a unique triple tax advantage. Digitally saving receipts lets you reimburse yourself tax-free later. When feasible, paying cash now can allow your HSA to compound. Always compare plan costs, employer contributions, and HSA fees. After age 65, non-medical withdrawals are penalty-free but taxable, while qualified medical withdrawals remain tax-free. To wrap up, use the decision flowchart to clarify when to pay cash versus using your HSA. Set up your digital receipt vault as soon as possible. Run the numbers, comparing an HDHP to other plan options ahead of open enrollment. For technical specifics and eligibility rules, refer to IRS resources such as Publication 969 and Publication 502. Now let's close with a call to action. Thanks for watching. If you found value here, please like the video, share it with someone who could benefit, and subscribe for more practical, research-driven financial content. Tell us your HSA strategy and questions in the comments. Your insights may help others too.